Thank you so much for taking time out, Anirudh. Well, this is the second straight month of consistent performance with gains of more than 9% compared to, around about what, 1% rise seen in the Nifty 50 in the month gone by. Please
Mhm.
take us through the performance of your fund, Growth Pro Max Fund, in the month of September.
Okay, Kshitij, since we are talking about past returns, a couple of quick disclaimers. First of all,
Sure,
any returns that we talk about, the past returns that we talk about, are in no way a guidance for the future. Yeah.
absolutely.
Secondly, any stocks, sectors, or groups that we discuss today, INVasset and its partners and investors may have vested interests. So please consider your financial advisor before investing. That's always safe to do. And when
Absolutely.
we talk about returns, we at INVasset believe that India is going through a magnificent journey. This is the luckiest time that is out there, the $2 trillion to $10 trillion phase that we are going through, the extreme growth phase, what they call it. Yeah, so we believe that the Indian economy would keep rising at around 8%.
Mm,
That is the bare minimum that we think about. A couple of years here and there is okay. And then we believe that the Nifty, as has done in the past, in the last, if you look at the last 3 years, 5 years, 7 years, it keeps on growing at 12%. So
mm,
at Invasset, we believe that the target that me and my team we set for ourselves is 1.5 to 2x Nifty. Okay, so
okay.
18 to 24% CAGR is what we focus on. Though of course there are no guarantees here, but this is a target that we set for ourselves. Following
Absolutely.
that target, we have been just investing, and if we look at the last 3 years, the Nifty itself has risen at around 19%. Okay,
Mm,
so if Nifty is risen at 19%, we have done around 45%. We are on the upper band of that target. Yeah, and if we are talking about September we were around 9.5%, and the BSC 500, which is our benchmark, was
right.
around 2.1%, and the small cap was around 1, and the mid cap was around 3. This is generally those indexes that we are focusing on, and our companies belong to these groups. So
Mm,
yes, the
mm.
only takeaway that I have from this is that from the September performance is that we have been selecting the right stocks and we are on the right track. So let's not
Mm.
disturb the trajectory that we have.
No, no, absolutely, and I'm sure the momentum will continue in the future as well. And it's a fairly new fund. In fact, you launched it back in 2020, and in a short span of time, in fact, you've rewarded investors with handsome gains. So, if someone would have, let's say, invested 50 lakh at the beginning of the fund, what is the kind of returns the person must be sitting on?
Yeah, okay. So my first investor I still remember is very, very close to me. So she invested 55 lakh rupees on 8th of January 2020. So last week when I checked, it was around 2 crores and 3 lakhs. So
Okay.
those 55 have transformed to 2 crore 3 lakhs. So the return is the absolute return is around 269%, and the
Mhm.
CAGR is around 39%. Vis-a-vis the market CAGRs are around half of that in terms of CAGR. So yes, we've been doing good, and yeah, markets have been kind to us.
Absolutely. Well, on that note, before we go ahead and move ahead with the discussion, I would request each and everyone who's watching this stream right now, in case they do have any questions related to the PMS industry or about the fund, do let us know. We'll try and take that up with Anirudh on this live stream. Now, consistent returns means that you are making the right calls and picking the right kind of stocks. Take us through your investment approach while selecting stocks for your portfolio. Anirudh.
Okay, so we are a 30-year-old fund house, Kshitij. We
Uh,
started in 1992 with Mr. Rajneesh Garg, our mentor, and my father, with a meager capital
okay.
of 10 lakh rupees. And today it's a considerable prop fund that we operate for ourselves. So all these learnings were given to us in 2013. And,
Mm,
being from a quant background, I try to quantify all of them so that when we are out there on the pitch, it helps us. To
right.
understand INVasset's model, we have to first understand that there are four type of investment styles out there in the market. Like
Mm,
90% of the fund houses, they follow one of these four investment styles. The first is value investing, where you buy below the intrinsic value and you sell above
mm,
the intrinsic value, which is called the value investing. Benjamin Graham, the father of modern investing in security analysis,
right.
taught us this. The second is special situation or growth based investing. This has
Mm,
gained popularity in the last 20, 30 years. Here, the hypothesis of an investor is that every bull run it has its new leaders, either in terms
Mm.
of a stock or a sector or a group or a theme, and this happens due to some change that has happened in the market in the last two to
Okay.
3 years. And due to those change, there'll be an spurt in the sales and the profits
Yeah.
of a particular set of companies. You just have to find out what that change is and how big the change is.
Yes.
Yeah. The third type of investment style is a quality based investment style where
Mm.
you believe in those high ROC, high ROEs, free cash flows, and then top managements having good market share, the products and companies having moats, all those Warren Buffett or Bharat Shah Sir type companies. You hold
Right.
them, buy them once, hold them forever. They are brilliant
Mm.
companies to hold. And fourth is a pension fund investment style where you say that, okay, my capital is very, very sacred. You cannot
Mm.
afford to lose it at all. You just generate me a little bit of alpha, that's okay. So your focus is on capital preservation rather than capital appreciation.
Right.
What we have INVasset have done is nothing fancy. We've just combined all four together, and based
Mm.
on various valuations of the market, we just choose one which to invest in. So when the markets are really, really beaten down and there is fear prevalent in the market, we go in with
Mm.
value investing. Our hypothesis is that we will hunt for value when there
Okay.
is overall value in the market.
Mm.
Sometimes during a bull run, what may seem value to me may be a value trap. Okay.
Exactly. Yes.
So I still remember back in March 2020, Tata Motors, it was available at the minimum 100 days of price to book in 20
Mm.
years of its existence on the exchanges. Last
Existence.
20 years, it was minimum 100 days. So this
Right.
is opportunities that you get during value investing. The second is when the markets they resume their course. When the new bull run sets in, we go in for special situation investing. Here, what we
Mm.
do is, or why the algorithm was needed to do it, because when we did our market research back in 2013, we found that majority, I would not say all, but majority of the fund houses were just focusing on the top 200, 250 companies, owing to
Mm. Mm.
the lack of resources. And it is very difficult to research 200 more than 200 250 companies when you are doing it manually. So what we did was we developed something called a relative change rewarding criteria, in which we
Okay.
focus on relative change. Very, very simple in layman's language, I would like to explain that today we are two companies, Anirudh and Kshitij. We are both very good
Mm.
companies. You, Anirudh being the bigger company. Okay. So
Right.
Anirudh is very, very good in dividend payment, and Anirudh is very good in terms of market share. And Anirudh is, on those absolute terms, I'm a very good company, and you are, say, a
Mm.
smaller company. But your plans for the next 2 to 3 years are much greater in terms of growth than mine. So we
Okay.
believe our
Right.
hypothesis here is that when the market
Mm.
resumes its bull run, it is focusing more on growth. It is hungry for growth. Wherever it will get growth from, the money would
Mm.
shift there. Okay. So these are the reasons
Right.
that we bought all those railways and defense, and there is a huge appreciation by Mr. Market, as I say, in
Mm.
terms of where growth is. So they focus on growth, and using this algorithm, we get top 100 companies where growth is possible. Now I have a set of 100 companies where growth is possible. Now my 10-member
Mm.
plus research team, it goes in individually to each and every company and then researches that whether what the algorithm is suggesting is proper or not, and is it good
Okay.
to go or not. Yeah. And now as the markets they become expensive, markets have a tendency to remain expensive for a very, very long period of time, as we saw from
Right.
2018 to 20. So that time we go in for quality investing. Now we will have
Mm.
all those Warren Buffett companies. Now here the hypothesis is that if there comes a market crash, then you may lose 20% temporarily. But if the market doesn't crash, your capital would not maybe grow at 18 to 24%, maybe in that time grow at 15 to 18%. So that is
Mm.
the focus. And sometimes in 3, 4, 5 years, you find a stage where the markets they become exuberant. All of us have
Mm.
seen those phases where your drivers and your chai walas and everybody, people leaving their jobs and going in for equity markets. So I
Yeah.
still remember 9th of September 2021, we exited the markets. We are one of the only fund managers which we take pride in saying that when the risk reward ratio is not in our favor, we say that we are
Mm.
investors and not stock market investors alone. And let's exit the markets and let's take a breather for some time. Let's
Okay.
enjoy the gains that we have made in the last 2 3 years, because capital preservation is much much more important than capital appreciation.
Hmm.
Also, I would like to add here is that at INVasset, we believe in a theory called the two-run theory. Okay,
Okay.
in the two-run theory, we believe that there is something called an old economy run and a new economy
Hmm.
run. So, a old
Okay.
economy run, you will see that the parameters that we talk about are generally high. So, there'll be high inflation, there'll be high growth, high
Hmm.
commodity prices, high capex. While in an old economy run, it will be the other way around. All of these factors would be low.
Hmm.
Okay, so in a new economy, old economy run, you would see that since the government capex is very high, the capex wheel has kicked in. All the sectors
Right.
like railways, defense, PSUs kicking in. And then you will also see that if the inflation is under control, inflation oriented sectors like real estate, autos, metals would also start doing well. While on the
Hmm.
other hand, you would see that in a new economy run, sectors like FMCG, pharma, IT, white goods, quality lenders like Bajaj Finance, HDFC banks doing well. In an old economy, you will see PSU banks doing well, because these they're lenders. The people to whom they lend
Hmm.
have started doing well. Also, you would see, must have seen a contrast between DIIs currently doing well. So DIIs, they do well in a old economy run.
Right.
FIIs, because of the stocks they select, they do well in a new economy run. You would see
Okay.
Nifty and India doing pretty well in
Hmm.
an old economy run, with Nifty hitting all-time highs first, and Dow Jones or Nasdaq doing better in a new economy run, with they hitting their highs better than Nifty. So
Hmm.
this is the world rotates between these two, and if we have to check, see, it started from where we have a day-to-day data on what we have researched in our algorithm. 1987. So January 1987, the bull run started, and it continued up till the Harshad Mehta time. Okay, then
Okay.
we saw
Right.
the Harshad Mehta crash.
Uh,
Then it started from 1990 to 3 April and
hmm.
continued till January of 2000, which we call the dot com
Hmm.
euphoria. And then there came the
Euphoria, I
dot
could
com.
say that.
Then from 2001 came again the old economy run, where you saw all those Unitex, Reliances, and
Hmm.
real estate and everything and capital goods going up. Then came the 2008 financial crisis. Then from 2009, what we saw was again, firstly started it started with FMCG, and then
Hmm.
IT and pharma, and then white goods and NBFCs. This is how
Hmm.
it goes. And now again, it is an old economy run, which we believe would be there for another 3 to 4 years. You know,
Okay.
Also, I would like to mention here is that a lot of investors have asked me that are small and mid caps, they look overpriced to you? Small
Right.
and mid caps, because the old economy run, it focuses on value rather than quality. The small and mid
Okay.
caps are the flavor. So the small and
Hmm.
mid caps would actually outperform the large caps in the next 2 to 3 runs, according to us,
Right.
till the old
In
economy
fact,
run.
interesting observations there, Anirudh, and I must say that I'm sure our viewers would take note of each and every point which you mentioned, in the conversation. No, you've been talking about investing, and there's another peculiar situation which is going on, and there are geopolitical concerns, and which could in fact escalate further. But this is not the first time when we are seeing conflict between, Israel or probably Hamas at this point in time. The valuation factor also remains high for India. The kind of rally or the kind of money which we have seen, entering into Indian markets, 60,000 crores of SIP money regularly getting invested in the Indian markets. Apart from that, FIs are also probably they've been taking out some bit of money, but the outflows are not that high. You could say that. So taking all this in cognizance, how are you viewing Indian markets in the current scenario? Have you increased your cash holding briefly for the time being, or you could say that?
Okay. So when we talk about the geopolitical situations, as Peter Lynch said, that there is always something to worry about in the market. So the
Exactly right.
geopolitical concerns that are out there, we are not at all, though they are very, very unfortunate, and such things should not happen. But these events, they actually provide opportunities in the market to enter. What
Hmm.
happens during such geopolitical events is that the volatility of the market increases. Whenever the volatility of the market increases, the fear in the market increase, and ultimately it leads weaker hands to exit the markets. This has
Right.
been going on for decades now. We can see, all of us have seen that in the past. So
Right.
Nifty being a leader index in the world right now, a leader index always have a tendency to approach 200-day moving average time and again. So the currently 200-day moving average is around 18,400, 500 levels. So that zone
Yeah.
Nifty can go in for sure. That will can go in, but is it for sure? No, nobody can tell. You cannot time the markets. But if it goes, it is a brilliant opportunity to enter a country which is going through a substantial transformation in terms of its capex and consumption. And a lot of money would be made by investors in India in the next 5 to 7 years. This is, I think, a surety that I believe is out there.
Right. You talked about 5 to 7 years. In fact, we got a question from Rihanna Mishra. Now, Rihanna wanted to ask you which sectors you are bullish on for the next 5 to 8 years of time horizon.
So see, Rihanna, we are firstly very, very bullish on the Indian consumption. Indian consumption, we believe that during this 2 to $10 trillion phase is a sector that is a sure bet. So consumption is something that we are bullish on and would like to increase our holdings going forward.
Mm,
Secondly, we are very, very bullish on the domestic capex that is going on, and particularly the
mm,
government capex. This government, not entering into the political side of it. Let's see what steps have been taken from the business point of view.
mm,
They brought in, it started with bringing in the GST. GST is a brilliant, I think, for me particularly after 1992, after Manmohan Singh, this is the biggest reform that has happened out there. It did not provide the government with the adequate capital and adequate resources
mm,
to fuel India's growth. It also provided a formalization to the economy. People
mm,
who were just focusing on evading taxes and chori and everything back then are now feeling themselves as businessmen and trying to grow their businesses, which have become formalized.
mm, mm,
Secondly, the amazing coordination that is happening between the RBI and the government. RBI did not
Correct.
give in to unnecessary SOPs, and then the government also helped RBI with funding the private sector, public sector banks, and also providing
Mm,
with the NCLT and insolvency laws. All these things are very, very important, and the government is also, I believe, that the government is also focusing a lot on how it has to grow in the next 10, 15 years. See how the vaccine rollout was there in the biggest
mm,
economy, in one of the most populated countries in the world, and then timely bringing of the PLI schemes and also the Atmanirbhar Bharat. The intention is right. So we
right.
believe that the Make in India theme is not a fad and a very, very real theme. You just go out there and see how much. I know any city. Kshitij, you're sitting in Mumbai. I'm sitting
Delhi.
in
Right.
Ludhiana. Somebody sitting in Delhi. All our viewers, just see how much work is going on out there. And I think it's a very, very
Absolutely.
normal theme. So all those sectors which are there in terms of capex like railways, defense, infrastructure,
Mm,
public sector banks, and when the inflation comes under control, which would ultimately will, then all those real estate. Just see, DLF launched a project in
mm.
Delhi, and it was sold out by the evening. So all these sectors, the capex oriented sectors, should be of the flavor for the next 3 to 4 years at least, Rihanna.
Right. In fact, talking about sectors, and surprisingly, the defense sector has a double-digit weightage in your portfolio. Although you've just highlighted, why you're so bullish on the India story, but do you think there is still value in the sector if you look at the recent run-up that we've seen in the defense space?
Okay. So we believe that defense is at a very, very nascent stage in India.
Mm,
For India, what we joke about at our fund is that for India, defense is not a luxury; it is a
mm,
necessity. You can
definitely.
order biryani from outside once in a while, but all those
Mm,
dal and rotis you have to cook at your home. So it is high time that India has now decided to cook its dal and roti at home now,
mm,
surrounded by hostile neighbors like Pakistan and China. Defense, we
mm.
cannot, there is a lot of foreign outgo in terms of defense and oil in terms in India, and this cannot
Right.
keep on going. And with this government's intention very, very right, we believe that the defense story has just started in India with the
Mm,
amazing geopolitical relations that India has developed with the West, all those
mm,
technology transfers and everything that are happening, as we saw in the HAL deal, And defense
Absolutely.
in India, it may be expensive right now, but expensive at a nascent phase and expensive at a matured phase is very, very different.
True.
Huh? So we believe that defense is still at least 3 to 4 years where defense should get expensive, or maybe not even till then. It's a story that you should invest for the next 10 years.
Right. Uh, you're also positive on banks and commercial vehicles as well as construction sector. Is it the pre-election euphoria that you want to catch on, or is it about the Make in India theme?
Okay, so Kshitij, the last change or churning that we did in our portfolio was in November 2022. So we are in October
Okay.
now. Not a single stock is
Right.
changed. So we are not playing any
Absolutely.
euphorias at all. And
Right.
we are, as I told you, we are playing that Make in India theme. I am when we talk about the construction sector or the construction ancillary commercial vehicles, I am just investing in what I'm seeing is working out there. Yeah.
Right.
In terms of banks also, we are very, very bullish on public sector banks, because we feel that, how I see lending business as a business which is the trickiest business out there. So you have in India two types of banks. You have your public sector banks and you have your private
Exactly.
sector banks. Public sector banks, whatever they do, let's consider them as the lazy ones. Yeah. They will not go out there and build their retail books until and unless there comes technology which helps them do it. And private sector banks are those good students in the class which will do all that is required to get the best. Yeah. So what has happened if we look at the last 20 years, from 2001 to 2010, all the public sector banks, they had gone in when the India Shining theme was there. They had lent, and we know that they are very, very bad lenders. They lend to anybody and do not look at the financials that much. While
Right.
the public private sector banks are the one which would closely monitor everyone and not go in for unnecessary lending. The public sector banks, they lent from 1 to 10, and then there was a time when everything collapsed and their capitals and everything had gone for a toss. Now during that time from 2010 to 2020, all the public private sector banks had done excellent lending and built amazing retail books which are noteworthy. What had happened during these times were these private sector banks, they started trading at very, very premium valuations which are not relevant or seen anywhere around the world. Likes of Kotex trading at 6 to price to book. You know, now now what has happened? All those old boys, the PSU guys, their ultimate consumers are in now a good shape, and they are now lending aggressively to you. So new books are being built,
Right.
and they will get a re-rating. Now when you're re-rating, when the money is flowing to growth from private sector banks to public sector banks, a re-rating would be done. They would come from say zero point 0.8 price to book to 2 price to book. They will come from 6 price to book to say 4 or 3 price to book or 3.5 price to book,
Exactly.
and this re-rating would be done. And ultimately we believe that the private sector banks would do comparatively much better than public sector banks would do much better than private sector banks going forward. But if you're
Right.
looking for a 20-year point of view, we still are like if 20 years we still that the private sector banks are much better.
Okay. So in the long term, probably private sector will win the race, and in the short term, you're seeing a
Yes,
re-rating for
there
the
is
public
immense
sector.
difference, in the rating and the multiples. That difference needs always comes down during a old economy now.
And what about the commercial vehicle and construction space?
See, we are not exactly bullish on the commercial vehicle as such in buses and all. We are more bullish on the construction related commercial
Okay.
vehicles, all those
Right.
road building things. So we believe that India is going through a massive transformation. All of us can see that in terms of building of infrastructure, and this story should be there for another 5 to 7 years.
Right. Well, on that bullish and strong note, thank you so much for your time, Anirudh. And that's all for now. But do stay logged on to ET Markets live stream for more investment and trading ideas. Thank you so
Thank
much
you,
for your time.
Kshitij. Thank you so much.